Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. Virendra Kumar is with us in our Delhi studio, and it's time for our product review of the week. This week we're looking at the Morgan Stanley Growth Fund. Avan is here to give us an introduction. Avan.
The Morgan Stanley Growth Fund was launched in 1994 and spent its first 15 years as a closed-ended scheme. Since then, the fund has trimmed its holdings to a mere 10% of its original 338 stocks, and it also converted into an open-ended fund in 2009. Now at inception, it placed among the top 5 equity funds and even bagged the 3rd position amongst its category average in 2003. However, it could not sustain this performance. In 2007, the fund's IT holdings faced a heavy setback and its returns fell below the category average. This slide has continued over the last 3 years, and the fund has given only 12% returns since its launch. It now depends heavily on sectors like banking, FMCG, and healthcare to woo back investor sentiment. To sum it up, if you invested 1,000 rupees in this fund when it launched, you would have 1,052 rupees today. So despite its underwhelming track record, should you include it in your portfolio? Our experts are here to give you the answer.
Thank you, Avan. Virendra, when we look at this fund on your website, you rate it as above average risk and below average return. Does it mean that the returns the fund has been given right now doesn't justify the risks we're taking?
Absolutely, and it has such a long history of below average performance that it's quite amazing that, it still has such sizable amount under management. And this is among the few very old funds. And, if you look at the past 10 years, in these 10 years, 5 years, it has not been able to match its own benchmark, which looks like a fairly easy target. Defeating the benchmark by most actively managed Indian equity funds has been relatively easy. And this fund has not been able to do that. Is quite disappointing. I think, this fund should not be part of one's portfolio.
You did say that it's time to pull your money out, but with 1,200 crore rupees in assets under management, there are investors still in this fund. Can you give them better options within that category that they can look at?
Yes, UTI Opportunity is an impressive fund. Likewise, the other fund which Morgan Stanley floated about 3.5, 4 years back is also very impressive. The Morgan Stanley 8 fund, which can invest across the market capitalization, and it has been a fairly impressive fund. Compared to this, it's really disappointing that such a stark difference in performance of two funds from the same fund house.
Right. Finally, Virendra, your rating of the Morgan Stanley Growth Fund, where would you place it?
I would, place it exactly the way it is getting slotted on our risk-adjusted performance scale, which is 2 stars.
All right, 2 stars there for the Morgan Stanley Growth Fund on Investors Guide. Let's move on now, Virendra, to our hold or sell segment. Vignesh is written in. He tells us he has a monthly income of 40,000 rupees and he's investing about 9,000 rupees a month in his mutual fund. He has a family that he's supporting and he's also paying a home loan. Doesn't seem to have enough life cover. But his goal is to accumulate a corpus of 2 to 3 crore rupees before his retirement in 2030. Now, he sent us a list of the funds he's been investing in. He has the HDFC Equity, which is the first on his list. He has 1,000 rupees going into this fund. Should he continue investing?
Yes, this is a fairly impressive fund and he should continue investing.
Reliance Banking Retail is the next on his list. Now, banking had been doing well over the last year, but do you think he needs a banking-specific fund in his portfolio?
Generally, it is avoidable because it only adds risk. It should be there only if he is deliberately wanting to supplement his portfolio performance and is bullish, he is upbeat on banking.
His other 2 funds on his list, the next 2 are also sectoral funds, and they are sectors that haven't been doing very well. Reliance Diversified Power and Reliance Infrastructure. Would you recommend he gets out of both of these funds at this point?
Absolutely. The Reliance Diversified Power Fund, the people just got carried by the name Diversified Power as if it was Diversified Fund, but it's the Power Fund. And it was extremely difficult to dissuade people not to invest when the going was good. And now we see the perils of such concentration or choosing a sector fund when the tide turns around. Exactly for this reason, it should be avoided and it should not be part of any portfolio in any substantial way.
All right. He also has a pharma fund, Virendra, Reliance Pharma, on which he's investing 1,000 rupees. Now, a lot of investors consider, since pharma is a defensive sector, it makes sense to have a pharma fund. Would you recommend he continues investing in this one?
No, even, exactly for the reason that today FMCG and pharma fund or a auto fund will be doing very well. Today they show the kind of returns which no other equity fund is able to match. But that is precisely the point, that when you diversify, you are trying to overcome the cyclicality, and you are able to be somewhere, you are likely to do well. Your goal should be to beat the market on a relative basis and diversify. These are two things which is in your control. If you are trying to assume greater risk, concentrate, that is not the reason why you buy a mutual fund. So exactly for that reason, even if pharma or FMCG fund might look impressive, keep away from them. Otherwise, their time will also come when they will look as disappointing as diversified power fund.
And the last three funds on his list are equity diversified funds. He has the DSP BlackRock Top 100 Equity, Birla Sun Life Mid Cap, and Reliance Regular Savings Equity. Of these three funds, Surendra, would you recommend he continue investing in all of them?
Yes, he should continue investing in all of them. They are all reasonable funds or good funds. That apart, he will have to get little more aggressive, because if we drop the sector funds and the thematic funds from his portfolio, then his portfolio becomes reasonably moderate. At least he should, think in terms of having two flexi-cap fund or multi-cap fund and two large and mid-cap funds, adequate diversification, having one or two small and mid-cap choice, and the aggressive ones to achieve his target.
So Vignesh, remember, you need to stay away from those sectoral funds, especially with your long-term horizon. Stay with the equity diversified funds. They should do you well. There were questions from Zubin D'Souza, who's written to us on behalf of his friend. He tells us she's 55 years old and she's separated from her husband and she's currently unemployed. She does have savings of 10 lakh rupees. She wants to invest them in a place that will give her a regular income while protecting her capital. Where should she be investing her money?
I would say the kind of dependence which she will have on her, income from investment. She should just put her money in post office MIP or a bank fixed deposit. It will be tax-free in a sense that if this is the only income, and if the interest income will be far lower than the taxable bracket, and she should not take chances with this money.
Zubin, you can write back to us if your friend needs any more help with her investment. Surendra, thank you so much for spending time with us on Investors Guide and answering our questions. We look forward to having you back soon on the other side of this break. Anil Sehgal will join us to answer your insurance questions, so don't go anywhere.